Understanding tax rebates can save you thousands of rupees each year. For the financial year 2025 to 2026, India offers two tax regimes with different benefits. Let's break down what each regime offers so you can make an informed decision about which one works best for your financial situation. The old tax regime provides numerous tax-saving opportunities through various deductions and exemptions. The most significant rebate under this regime is Section 87A. This is the only true rebate that applies after calculating your tax. It's available only to resident individuals whose net taxable income does not exceed 5 lakh rupees. The rebate amount is 100% of the income tax or 12,500 rupees, whichever is lower. Effectively, if your taxable income is 5 lakh rupees or less, your tax becomes zero. An important change for financial year 2025 to 2026 is that the Section 87A rebate cannot be used to offset tax on special rate incomes like short-term capital gains on shares or long-term capital gains. It only applies to your regular slab rate income. The old regime also offers a standard deduction of 50,000 rupees for every salaried professional and pensioner. This is a flat deduction from your gross salary before any other calculations. One of the major advantages of the old regime is the Chapter 6A deductions. These reduce your taxable income before tax calculation. Section 80C covers investments like PPF, EPF, LIC, ELSS, home loan principal, tuition fees, and NSC, with a limit of 1,50,000 rupees. Section 80s allows deductions for health insurance premiums up to 25,000 rupees for yourself and family, and an additional 25,000 or 50,000 rupees for parents, depending on their age. Additional MPS contributions under Section 80 CCD 1B can give you a further deduction of 50,000 rupees. Interest earned on savings accounts can be deducted up to 10,000 rupees under Section 80 TTA, or 50,000 rupees for seniors under 80 TTB. Donations to recognized charitable institutions are also deductible under Section 80G. The old regime also provides special exemptions for certain allowances. House rent allowance is exempt based on the rent you pay if you live in a rented house. Leave travel allowance is exempt for domestic travel costs twice in a block of 4 years. Interest paid on a home loan for a self-occupied property is deductible up to 2 lakh rupees under Section 24B. Now let's look at the new tax regime. The new regime offers simpler taxation with lower tax rates but removes most specific tax-saving investments. The Section 87, a rebate limit is higher, covering income up to 12 lakh rupees with a maximum rebate of 60,000 rupees. The standard deduction is also increased to 75,000 rupees. However, choosing the new regime means foregoing several deductions. You cannot claim Section 80C deductions for investments like PPF and LIC premiums. Health insurance premium deductions under Section 80D are not available. Your entire house rent allowance becomes fully taxable. The 2 lakh rupees deduction for home loan interest on self-occupied property is not allowed. Interest earned on savings accounts becomes fully taxable. Leave travel allowance exemptions are removed. Professional tax deduction of 2,500 rupees is no longer available. Other minor allowances, like children's education allowance, are also gone. Deductions for charitable donations under Section 80G are not allowed. Despite these limitations, some deductions remain available under the new regime. You get a higher standard deduction of 75,000 rupees. Employer contributions to NPS under Section 80 CCD 2, up to 14% of your salary, are still deductible. Family pension deduction has been increased to 25,000 rupees. Contributions to the Agnivir Corpus Fund remain deductible. Certain specific allowances are still exempt such as conveyance allowance for employees with disabilities and daily allowance for official travel. Gratuity and leave encashment upon retirement remain exempt. While you lose interest deduction for your own home, you can still deduct interest paid on a rented out property. To summarize the key differences, the old regime allows deductions under sections 80C, 80D, 80G, and exemptions for HRA and LTA, with a standard deduction of 50,000 rupees. Income up to 5 lakh rupees can be tax-free via the 87A rebate. The new regime does not allow these deductions, but offers a higher standard deduction of 75,000 rupees and makes income up to 12.75 lakh rupees potentially tax-free. Employer NPS contributions remain deductible in both regimes. Your choice between the two regimes should depend on your income level, investment patterns, and whether you have significant deductions like home loan interest or rent payments. For those with few deductions, the new regime might offer better savings, while those with multiple tax-saving investments might benefit more from the old regime.